Exam, as I said, next week. So just to clarify a couple logistics items. So on Wednesday, as in 2 days from now, Mike Cichello will be here as our guest lecturer. He wrote the 6th edition McKinsey workbook for the valuation. It was part of the original. The team also worked on the 6th book overall. And I told him what we were doing, and he's going to be talking about revenue decomposition and drivers of understanding revenue over time. And he also is going to bring a case study to the class as well. So look for that material posted probably either Tuesday night, Wednesday, early morning. But he'll be here for all 4 sections, and he'll be teaching all day on Wednesday. Next week is the revised midterm scheduled week. So Monday and Wednesday are midterm exam days. So just remember that on Monday, 1 week from today, midterm part A or part 1 will look exactly like homeworks 5 and 6. All right, except you'll have 90 minutes to do it, and you must do it during class time that you're registered for. Okay, so whatever section you're registered for, some of your hopping sections, based on ELMS and Canvas and UMEG, is what you actually have to take the time for. So you'll have that 90-minute window unless you have a different arrangement with me. Then for part 2 of the midterm, and part A, part 1, whatever you want to call it, is just during that 90 minutes, is just going to be like the last 2 homework assignments, homeworks 5 and 6. Okay, and the solution to homework 6, by the way, has been posted on ELMS. All right, so part 2 or part B of the midterm will also be available on Monday, and you'll have 5 days to do it, right, including class time on Wednesday if you choose. And when you start it, you'll have 90 minutes to complete it. Okay, so you can choose any time next week to take part B, and then you'll have a 90-minute timer, and you'll have to finish part B during that 90 minutes. Okay, so both parts, you'll have 90 minutes. Part A, you have to take during class time on Monday. Part B, anytime during the week. You'll take them both over the internet from any location. So you don't have to come to class to teach it, or to take it. You can take it anywhere you want. Right? And then the following Monday, which will be the 17th, we'll be back in this class, and then we'll start on the valuation model. Okay? So that's our plan for the next coming up classes. Questions about the logistics of anything on that? Yes? So part B is going to be essay questions, open-ended questions. And I will tell you, 2 of the questions are going to be, here's a CFI, go through it and explain it. Here's a ROIC tree, go through it and explain it. That will be probably at least a quarter of part B of the midterm's grade. So that's why we're doing the practice right now. If you don't know how to do that, you're going to do really poorly on part B of the midterm. So what we're talking about now, what we talked about last Wednesday, very important to part B of the midterm. Okay? Yes?
So part B will be available next Tuesday?
It'll be available next Monday.
Monday.
And you'll have up to 5 days to take it, but you won't see the exam until you start taking it.
So Monday to Friday?
You have between Monday and Friday to take it.
Okay.
So when you click on the link for part B, it'll start a 90-minute timer, and then you'll see the questions. So you won't see the questions until you start the exam. You have a 5-day window to take the exam. Part A, you have to take it on Monday during your registered class time. But you'll take both parts, A and B, next week. A, one more time, is just a conversion, just like homework 5 and 6. B will be open-ended essay questions. But I'm giving you, right now, a hint that 2 of the questions are going to be, here's a company, explain the CFI. Here's a company, explain the ROIC. Okay? That will definitely be on the exam next week. And question number 3, whatever Mike Cichello talks about on Wednesday, there will be a question on that on the exam. So I've already told you what 3 of the questions on the exam are going to be. Right? Yes?
Is the guest speaker going to be recorded?
I don't know. If he can figure out how to record it, then yes. If he can't, then no. But hopefully he'll be able to figure it out. Okay? Yes?
For part A, you don't have to be in class to take it.
For part A or B, you don't have to be in class at all. So next week, you're taking the exams remotely. You'll not take them in class. So rather than taking it in class, you can take it anywhere you want. Okay? Yes? No.
Was that before?
Nope. You never had to be in class for the midterm. You just had to take it during class time. Yes. So if you want to come, because the room will be open, you can take it. But you don't have to. You can take the exam anywhere you want. You'll just need an internet connection. You will need Excel. And you'll be able to access Canvas, because you'll take the exam off of Canvas. Right? So let's go back to this. So let's talk about deltas ROIC as another practice, right? And very important today. I don't need the practice. I do these a lot. So you guys need the practice. So somebody, if you want to practice walking through this, I'll give you kind of a critique on this. But as you're practicing, remember, you must refer to specific numbers. Because if you just talk in generalizations, we'll have no idea what you're talking about. Because you could be looking at the wrong numbers and get a right answer. All right, so in order to get a true answer, you got to make sure as you go through this, you're talking through answers. So do you want to try the delta ROIC?
Sure.
Okay.
So I started with like the ROIC tree.
Okay.
That was the first thing I looked at.
Yeah.
And you know, just looking at the first level, it's 7.2% return on invested capital in 2011,
Okay.
7.4 in 2012, and then this huge number leaps out at you, which is 39.1%. So obviously they're doing something big that's drastically increasing their return on invested capital at that point. So
Okay.
then I went over to the next level, and first I looked at end of year pre-tax ROIC. So you got 6.9% in 2011, 7.4 in 2012, 11.2% in 2013, 8.1% in 2014, and then you have a 304% increase from 2011 and 2015, which is 27.7. So if you look at that, and then go into operating margin next.
Well, before you do, just talk about the tax rate.
Okay, so then the cash tax rate, that's also like a huge thing because it goes from 5.1% in 2011. So obviously they took some sort of write down then. In 2012, it's 0.9%, so they didn't have a write down. They're operating at somewhat of a profit because they need to pay taxes. And then in 2013, they had this huge negative tax rate, cash tax rate of negative 248.5%. So at that point, you kind of want to go over and figure out what that is. So I switched over to the CFI at that point. And I looked at no plat first because that's the first line item. And in 2013, their net operating profit after taxes was 11,804 in millions, 11,847.8, which is, you know, more than like 10 times more, or more than like 5 times more what it was in 2012. So
Which goes back to that tax refund.
Right.
So something, they got a one-time benefit in
Right.
taxes.
So maybe they made an acquisition at some point and they had to write it off as unprofitable. And then if you go down, their depreciation for 2013 was normal, but their gross cash flow was massive. It was 13,505.8.
All right, we'll stick with
from the
the
cash tax
ROIC first, though.
Okay.
Okay.
So then going back here, you know, like the cash tax rate rolled over and it gave them a significant boost in no plat. So then if you look at invested capital over sales, goes down 15.7%.
Did that help or hurt them?
That hurt them.
Okay. No, it's the other way.
It is the other way?
Yeah. If I'm spending less invested capital to generate
Right, because
sales,
they're generating the same amount. With
I'm
less
becoming more
invested capital.
productive. So they
Okay.
actually got about a 15.7% increase in productivity.
Right. So then, if you go on to the next level from there, the thing that leaps out immediately is operating working capital over sales. That went up by 38.4%.
Okay.
So that's not good because of the fact that they're needing more working capital to generate the same amount of sales.
Normally that would be the case,
Mhm.
except look at those parentheses.
Oh, that means it's negative.
Yeah.
Okay.
So it actually went more negative.
Okay.
So you got to be careful when you see the parentheses there. That means negative working capital. Negative working capital occurs because I have more liabilities than assets.
Mhm.
So that means they have even more
So they
liabilities
took on a
relative
bigger
to
debt
assets.
load.
They took on bigger liabilities.
Right.
Yeah.
So then PP&E over sales is, you know, that kind of stays flat. Intangibles over sales goes down by 13.1%. That's probably because they probably dispersed the acquisition that they made at some point, right?
Well, either way, we don't know that, but we can infer we have to go check that out. What's more important is they're getting more productive.
Right.
Now, let me just stop you there because unfortunately, one of the things that you're doing quickly, and it's easy to do, is you're going to generalizations. And again, I know it's tough, but you got to keep talking about the numbers all the way through. So even when you say it went down by 13%, it would still be helpful if you say from 41.4 to 36.
Okay.
Right? It's just good practice for everybody. It will help us grade it. It will help you understand it. It will help you understand what we're talking about. So going back, so the key is just to make sure is that a lower invested capital over sales, which is a driver of productivity, basically means you're more efficient because you're not using as much capital to drive revenue. And as he pointed out, One of the drivers was working capital, which went more negative. So they're adding more liabilities relative to their assets, probably accounts payable, not paying some suppliers because it's short term, but nonetheless, that's what's helping them. They're getting improvement in working capital, right? Then PP&E to sales stayed flat, right, which is also important to know. And then, because that's the planes, right? And then the final one is intangibles. So basically intangibles, as we said last week, is a fixed cost. This is the acquisition premiums. So it doesn't look like between 2011 and 2015, they're doing a lot of acquisitions, right? So basically what it means is they're getting more productivity of the previous acquisition. Think they bought Northwest a long time ago. So they're getting more productivity as they're growing, but they didn't pay any more for Northwest, but they're getting some growth out of that acquisition, right? So that's the way to think about what's driving it there. But nonetheless, the intangibles going from 41.4 to 36 help them. The working capital going from negative 17 to negative 23.4 helped them. The PP&E stayed flat. Right? Yes.
I don't know if this is going to get there, but you go in depth to how they're operating margin.
Why don't you take a shot at that?
Honestly, I couldn't figure it out. That's what I was trying to focus on the most.
All right. Well, the pre-tax operating margin, if you want to continue, you're doing a great job.
Okay, so I kind of touched on this before, the pre-tax operating margin. So there's that big increase from 6.9% up to 27.7% in pre-tax ROIC from
Yep.
2011 to 2015, so that's a 304.3% increase.
Okay.
So then if you look at the next level and look at operating margin, it goes from 0.056 to 0.059 to 0.09, and then down back down to 0.55. And then increases significantly to 0.192. So that's an increase of 240.8%.
So if you really look at it, the biggest driver for pre-tax ROIC, and for that matter, after-tax ROIC, was that big jump in operating margin. So they're making, instead of making in 2014 5.5 cents of profit, they're making almost 20 cents. They're making 19.2 cents of profit.
What's the next step after that to explain?
Well, go to the next level down. But before we do, does anybody know what this is really happening in the real world? Because unlike we talked about McDonald's, which was because of an accounting reclassification, this was actually a real benefit to Delta Airlines. This was fuel costs. Because remember, oil used to be in 2014 over $100 a barrel. Now oil's in the 40s. So it's the drop in fuel costs pretty dramatically, the drop in oil prices, which really helped their operating margin. Yes.
So you wouldn't have to explain that on exactly, but you need to know that pre-tax concept.
So, so for the midterm exam, you wouldn't have to relate it to the fuel costs and give that comment. What would be more important, though, is you identified the big trend. So you identified that it went up dramatically and why, right, in terms of the next level down. For your group project, after the midterm exam, where I'm going to give you a month to work on a real company, I would expect when you do that presentation that you've done enough work on Delta that you would have figured out was the fuel costs. All right, so that's going to be the difference between your group project and the midterm. Midterm, you're just kind of playing with numbers, but eventually you can't just plug and chug, right? Because that's the key to this class, is that everyone in this room knows how to plug and chug. You know how to solve equations. You know how to do math. You wouldn't have made it this far in your undergraduate career if you didn't know how to do that. And so now we got to go to the next step, which is it's not about the math, right? Everybody can do that. So what does the math tell you? Right? So there's reasons why the math is changing, and that's what we have to try and figure out. And that's where it probably involves, number one, identifying where the math is changing, the linkages, and then two, going into the real world to try and connect some dots. So that's eventually what we have to practice doing. And this is the art of valuation as opposed to the science of valuation, right? And we're doing both, right? But for the midterm, no, I'm not going to ask you to connect it. I'm not saying you don't have to if you know the answer to do it for whatever company I give you. But you don't have to do that one. Because I'm assuming you don't know a lot about these publicly traded companies. Right? So, back to this, what you should say is that the gross margin has been pretty consistent for Delta over time from 1.043 to 1.045. It hasn't changed that much. And it was really the drop in SG&A from 94.4 to 80.808. That was the big driver of the improvement in operating margin. Right? Because depreciation didn't change much. Gross margin didn't change much, but SG&A went down dramatically.
They wouldn't account for fuel costs and gross margin.
Well, here's the one challenge. If you look at gross margin is more than $1. Well, that doesn't make any sense because revenue should be $1. So again, this is actually a classification issue with Bloomberg. The way Bloomberg is classifying gross margin, something's weird. So it's basically what they appear to be doing is, and this is just industry, is that they're basically saying gross margin is only including, because they don't break out cost of goods sold and SG&A, so they're lumped together into that SG&A line. But it does include what's called other revenue. So when you add in their other revenue, they're above $1, and then they subtract it all in the SG&A.
Can it be because they're getting a subsidy?
It's whatever that other revenue is.
Okay.
So they're getting some other revenue. All right. But regardless, and this is the key, when I look at it over time, the gross margin is not changing all that much. So that's what alerted me that there had to be an accounting change at McDonald's, because both the gross margin spiked and the SG&A spiked. Here, the gross margin is staying the same, and the only thing that's changing is the SG&A. And I happen to know that fuel prices last time I filled up my car are a lot cheaper than they were 2 years ago. So basically, it's benefiting a lot of people, and this is the key to the airlines. But part of the reason why we're doing this, I want to keep your eye on the big picture, is post-midterm, we're going to be valuing these companies, which means you're going to have to do 2016, 17, 18, 19, and 20 if we were doing Delta Airlines. And the worst forecast, when you read in the book, is to actually predict an actual number, right? Meaning you don't forecast revenue. You don't forecast income. What you do is you forecast the ratios, right? So when we forecast Delta, understanding what its operating margin is will tell us what the profit will be. So that's going to be best practice in what we're doing. So by doing this analysis, we start to get a feel for the company that we are going to forecast. Ideally, we probably want to go back more than 5 years, but at least over the last 5 years, what we're doing. And so here's the thing. What do we know about Delta now? If we're forecasting Delta, what are some of the things that we will now know? Yeah.
The gross margin is fairly consistent as well as the depreciation.
Yeah, exactly. So that means their invested rates are probably consistent, their gross margin's fairly consistent, and that's relatively predictable. What's not so predictable? Yeah. And that's the other key. It's that the cost of oil is actually going to be a key driver of any valuation we do with Delta, because that element outside their control, which is a very big cost as it rises and falls, is going to have a huge impact on Delta Airlines. And we're seeing how big of an impact it can have, which probably means that, do we really realistically think that their gross margins are going to be 19% going forward? Right? What would be key to gross margins of 19% going forward? Yeah. Or staying where they are, staying in the low 40s, right? And realistically, if we think they're going to be $60 a barrel, call it that, then they're probably not going to have 19% margins. If we think they go back above 100, they're probably going to have high single-digit margins. And so that will eventually influence our valuation of Delta, because at different margins, you're going to have different cash flows. Right? So this is what eventually we have to start thinking. But that's the first thing. As somebody said in the last class, I think they said it well. He said the other inference he made with Delta is that I need to forecast a sign. Like it's going to be a curve. Right? It's not going to be a straight line. Right? And that's because they're going to be a cyclical business. You clearly see it here, even over this 5-year period of time, if we were forecasting Delta Airlines. We had to forecast some cyclicality into the forecast that we do. So, matter of fact, PP&E to sales has been extremely flat over that 5-year period of time. So that's the other thing, is that they're consistently buying planes at a very consistent rate as they're growing. Well, again, that tells me that when I forecast what level of investment in facilities, in this case planes, I know it's probably going to be at this level over time. So again, it will help me when I do my forecast. Right? So that's part of what we're also doing this historical analysis to set us up for. Yes?
Can you go back and explain again how we were talking about the tax rate and the ROIC in 2013?
The which one? The tax rate?
Yeah.
Well, generally, when you have a negative tax rate, it basically means you're getting money back from the government. The joke that somebody made earlier was they said it's the Trump effect. That you saw the New York Times story over the weekend. He had a giant loss, doesn't pay taxes. Well, the same thing's true with companies. Basically you have 2 years of what are called carrybacks, which means as a company, not an individual, as a company, if you lose money, then the IRS will let you apply that to get a refund against some past taxes paid. And then they'll let you do something called NOLs, net operating losses. You'll get carry forwards to write them off against future incomes. So there were 2 tax events that happened with Delta. One was in 2011, one was in 2013. where they didn't pay taxes and they got refunds, right? Now, again, just looking at these numbers, you don't know why. But obviously, it was substantial for Delta in 2013, so we'd probably want to go try and figure that out someplace else. And most likely, that's not going to be recurring. Like the IRS is not in the habit of generally just giving you refunds to give you refunds. So that's probably not realistic of what their tax rate on a go-forward basis is once they are profitable. But if you remember, the airline industry used to lose a lot of money, right? This is kind of new for them to make so much money, right? So nonetheless, that's one of the things we'd have to check into. But here's the point. It helped their pre-tax ROIC. So their pre-tax ROIC, their after-tax ROIC, the cash tax rate helped, right? Because of negative tax rate. But over the 5 years, going from a negative tax rate to a positive 37% rate, that hurt their after-tax ROIC. So having a negative tax rate helps your ROIC. When you go from negative to positive over the trend, it made the ROIC worse, which makes the pre-tax performance even more impressive. And again, the pre-tax was all the operating margin, which led to the giant increase in pre-tax ROIC. Okay? That's this insight I want you guys to have.
Which year were you saying made it more impressive in 2014?
The going from 2014 to 2015. That's a gigantic jump. Because the margin went from 5.5 cents to 19 cents. Because the SG&A went down, in this case, because the cost of oil went down dramatically. We could directly link it to that. I'm sure they probably did a few other things to improve performance at Delta, but it was the price of oil. Which also goes back to, they got lucky. I mean, to be honest with you, because the price of oil doesn't change, numbers don't look this good. So they were lucky that they were in an environment where the cost of one of their key components went down. Yeah.
So for the midterm, we have to go through
The numbers,
The
not the
numbers.
insights.
and see
Connecting some
why-
dots, but not
why
yet.
they either helped or hurt the ROIC.
Yes. I want you to practice thinking about it that way. Because this leads to the next statement. ROIC is a proxy for cash flow. So we should see similar trends showing up on the CFI. So if you see a big jump in ROIC, you should probably see a big jump in free cash flow. Okay? So would we see that? Let's look at the next statement. Right? So statement number 2, CFI. We want to walk through this. Now in this one, I didn't give you the total. I just gave you the 5 years. So we do want to walk through kind of the 5 years. And for purposes of the midterm, what I would say is highlight the most important things as opposed to walking through every number every year. You'll run out of time. But remember, there's 4 sections of CFI. Operating, non-operating, debt, equity. Explain those 4 sections over time. So for Delta, what happened to their operating free cash flows? What do we see here? What? Big jump? Yeah, big jump in 2013. That was the negative taxes. But if we looked at 11 to 15, they still improved. They went from about $4 billion of gross cash flow to about $6.8 billion of free cash flow. Sorry, gross cash flow. And that led to $3 billion of free cash flow up to $4 billion of free cash flow. So here's the next thing we notice is particularly capital expenditures, but the gross investment went from essentially $500 million, $478.2 in 2011, to almost $2.5 billion in 2015. And that was driven by capital expenditures, buying planes. Right? So obviously Delta's been buying more planes, which makes sense if you're getting more profitable. Heck, invest in more planes. Right? But what is Delta's reinvestment rate? If you had to forecast a reinvestment rate for Delta going forward, what number would you use? Yeah.
13%.
You would actually use 13 going forward?
Definitely not 57%.
You think 57 is too high?
I think that's a one-time thing. Yeah.
Okay. So that's the thing, is that they went from 13 to 57, and they went as low as negative investment, disinvestment, negative 37, and then they're at 36. So that would be the point. We'd have to come up with, all right, they've been bouncing around what is a reasonable level of investment. And one of the things we can see is back to the cyclicality. Even airlines, they don't buy the same amount every year. They're kind of up and down based on where they see the conditions of the marketplace. And they're kind of changing around. So again, it should eventually influence. But nonetheless, over time, this is probably averaged out to be somewhere around 20 to 30%. Okay. Now, they had $4 billion worth of free cash flow in 2015. What'd they do with it? Because if you don't reinvest, what do? You pay it out. So, and if you don't completely pay it out, you put it into excess cash. So looking at the free cash flows over the 5 years and looking at the change in excess cash, did they put it all in the bank? Is it all in excess cash? Is all that free cash flow in excess cash? No, in 2011, they did, and we can see this here, they basically took down their excess cash by $60 million. 2012 down by 270. 2013 increased it by 407. Then they took it down by 550. Then they increased it by 125. But given the size of these free cash flows, they didn't really keep a lot of it on hand and put it in the bank. Obviously, something really weird happened with these non-operating assets in 2013, which affected their CFI. But basically, the CFI went from $2 billion to $5 billion, mainly because of the big jump in cash profit between 14 and 15, because the no plat went up because their margins went up. Okay, so what did they do with all this cash in 2015? What did they do with this $5.4 billion? Paid some interest expense, $300 million. What has Delta been doing with its debt over the 5 years? They've actually been with their debt. What has Delta been doing with their debt? They've actually been buying back their debt. They're paying off their debt. So here's the thing. They're using all of this cash flow they're generating to retire debt. Yeah.
That was the increase in
Non-operating
non-operating liabilities.
assets and liabilities don't affect debt. But they had something, like I said, that happened in 2013, which we would want to figure out what that was. So there we got to read the 10K, 10Q, annual report, whatever, get some insight into what that was. But that aside, it's this column right here, this row, that tells me they're paying off a lot of debt. In fact, the next one down, retirement-related liabilities. So here's the point. The accountants, the actuaries, are telling Delta that to meet your retirement obligations, this is how much money you have to set aside. In the first 2 years, 2011, 2012, they were not setting aside $2.7 billion and $1.8 billion that was actuarially necessary. So in effect, they were taking loans from employees. Right? 2013, they made a catch-up payment of $3.6 billion. 2014, they didn't fund it by $2.7 billion. 2015, they put $1.2 billion into it. Right? But over time, Delta has been relying on not funding its pension to basically help its cash flow. It's basically borrowing money from its employees by not giving the money to its employees immediately. All right? Started paying dividends. What year? 2013. $100 million. Then 2014, $251 million. 2015, $359 million. But what they really started doing, as he said earlier, was they started buying back a lot of stock. $250 million up to $2.2 billion worth of stock repurchased last year. So in a way, Delta saw a windfall. They then used that windfall to reward the shareholders with a $2.2 billion purchase because of the giant increase in the price of oil. Questions about any of that? About the windfall?
Yeah.
I'm just saying that if you see the big jump in margin, proxy to the big jump in gross cash flow, I'm calling that the windfall between 14 and 15, which we attributed earlier to the big decline in oil prices. So I call that a windfall because suddenly they're making a lot more cash profit. So it was at this point in time which Delta decided to buy back a lot of stock. Yes.
So if you tell the story, you tell each section at a time.
Story is talk about what's happening with operating, which is free cash flow, the drivers of free cash flow, positive or negative, gross cash flow, gross investment, and reinvestment rate. Then, is the company doing something in the non-operating side? Generally, are they putting in the bank or not? Is the big key things, but there could be other things there. And then, once you get to CFI, if it's positive, what they do with the money? If it's negative, where'd the money come from? That's essentially the story you're always looking to tell. Right? Questions? All right. So, here's another question I'm increasingly putting on the midterm exam. Because it started out as a question in the first section today, and I'm going to ask you the same question. So, why would Delta buy back $2.2 billion worth of stock? What would be the decision rule that a company should use to buy back its stock? When should a company buy back its stock? Yeah.
Maybe when they perceive it to be undervalued.
No. That's the third time somebody has said that, and that is the absolute wrong answer. All right? So that's why I wanted to ask the question, because you have been taught wrong. All right? And just what's on YouTube now for the whole world to hear is, what did you say again? You buy back stock because you believe the stock is undervalued? No. No, no, no. All right, it's a misconception. All right, and I want you to understand why it's a misconception. All right, because you're taking this class. You guys need to be smarter than this. So, here's the thing. Let's work through this. Why do I want to pay out? Which is really the question I'm asking. Because if I don't pay out, what am I doing? I'm reinvesting. So the real question, if you really interpret it, is when should I reinvest and when should I pay out? Because if I choose to buy back stock, I am paying out. So what's my decision rule for that? Yeah.
Could it be when there's no projects with a positive NPV that are available to you, so you just are doing the thing that creates the most value to the shareholders?
Exactly. So if you don't have positive NPV projects, which in the language of this class would mean what? You have a negative spread. All right? If incrementally you don't have good spread, which means you don't have NPV positive projects, then you are better off paying it out. That's why you pay it out. If you have positive NPV projects and you can have a positive spread, ROIC greater than cost of capital, you want to reinvest. Because think about this. Cost of capital is an opportunity cost. And I'll simplify it. So if my cost of capital is 10%, okay, and I can make 20%, and if I give the cash back to you by buying it back, you're going to take that cash and you're going to go put it someplace else to make 10%. Well, why would you want to do that if you can leave it here and make 20? Like, you'd rather me reinvest if I could make 20% for the risk that you're taking, if that's the same amount of risk, than make 10. So don't pay it out, reinvest. All right? The reason why you want to pay it out is because you expect to make 10. And I think if I reinvest, I'm only going to make 5. Well, at that point, you're better off giving it back to me so I can go someplace else and make 10. And it's important to show the discipline not to waste the money. And by the way, it's not the historical rate of return that matters. It's the incremental future project that matters. All right? That's the first point. Yes? Does everybody get that? Does everybody understand that? Because that's fundamental to understanding the rule in the class. So that's the point. As a decision rule, the decision rule of whether to reinvest or whether to pay out should be based on your understanding of the incremental spread over time of the projects that you have. Right? That should be driving the idea of buying back stock. Because buying back stock does not affect the value of the companies. So that's the point. Saying a company's undervalued has nothing to do with buying back stock. Right? Because what drives the value of a company? What drives its intrinsic value? It's the expected future cash flows. All right? So look at, and this is what I'm saying, you can clearly see with the reorganized statements why that comment that we started with, buying back stock because it's undervalued, is flawed. All right, and here's why. It's right here on the screen. Look at 2014. Look at Delta Airlines. In 2014, which is this column, if instead of repurchasing $1.1 billion worth of shares, they repurchased $100 million worth of shares, and they paid $1.251 billion of dividends. So basically, they took $1 billion of stock buyback, and rather than bought back the stock, they paid out $1 billion worth of dividends. Okay? Does everybody see what I'm saying? My question? What does that do to the CFI? If I move $1 billion of stock repurchase to $1 billion of dividend payment, how does that change the CFI? What's the change to the CFI? Yeah.
Does it have to do with the tax rates between dividends and capital gains?
Now, what is the change to the CFI? It doesn't change. If you move these two columns, these two rows, move $1 billion here to $1 billion there, this number does not change. Your CFI does not change. And if your CFI doesn't change, your enterprise value doesn't change. Does paying a dividend versus buying back stock affect your free cash flow? This is why it's going to be a question on the exam. If you guys don't understand this, you clearly aren't paying attention in this class. Yes?
It doesn't change because you're paying out the same amount, whether it's in stock repurchase or dividends.
Exactly. So that's the point. Buying back the stock doesn't change your free cash flow. Buying back the stock doesn't change your CFI. Buying back the stock doesn't change your intrinsic value. Buying back the stock has nothing to do with the value of the company. So it doesn't affect that my company's undervalued because it doesn't affect the value. So that's why it's a flawed statement. Right? So why do people say this? Because what they have is what I'll call an expectation problem. Right? The reason I think my company's undervalued is because the people that are projecting those cash flows aren't giving me the credit for the future cash flows that I think they should. That's what they're really saying. Right? So does buying back the stock change that expectation? No, because it should change the expectation of the free cash flows, and buying back stock has nothing to do with changing your free cash flows. But people associate this. Right? So let's talk about behavioral economics for a second. Behavioral finance. So it's hard to see on video, right? But I'm going to do this in the class. So we're going to have a conversation with my two shareholders sitting here in the front row. You're both my shareholders. You both own 50% of the company. You both think that the company is worth less than I do as the manager of the company. I'm the CEO. So I'm going to go to you. I'm going to say, I think that your expectations are too low. You should revise them higher for reasons I'm telling you, and you should buy more shares and give me credit for a higher stock price. Okay? Then I go to you, and I say, I think that your expectations are too low. You should buy more shares, and you should give me credit for a higher stock price. And by the way, here's $20. All right. What's the difference in those two conversations?
I didn't get $20.
He didn't get $20. But what's the message I'm trying to give you? Does giving her $20 impact the message I'm trying to give you? The message I'm trying to give you is both of you have too low of expectations. See, the person that gets $20, I'm bribing into changing their expectations. That's the association with the undervalued stock. But what I'm telling you is you can have somebody adjust their expectations without giving them cash. And if you give them cash, they don't adjust the expectations, your share price doesn't change. So what really has to change the value of the company is you got to change the assumption of the business, which means the cash flow has to get greater over time. That's Modigliani-Miller. That's what the Nobel Prize in Economics was won for. Because they said it doesn't matter how you pay out. The payout doesn't affect the share price. Whether you pay out debt, whether you pay out equity, whether you pay out dividends or stock buyback, it doesn't matter. It's just a distribution of cash. And that's what we're seeing here. Now, we can then, for tax efficiency, choose to pay out differently. Because if I give everyone in this room a dividend, everybody gets cash, and everybody pays taxes. If we buy back the stock, then only the people that bought back the stock, that sold their shares, get cash, and only those people pay taxes. The rest of you don't. Okay? So some people argue that stock buybacks are more tax efficient because it doesn't force everybody to pay taxes. Right? And so that could be one of the reasons why I choose to do that. But theoretically, whether I give you cash by giving you a share buyback or giving you cash by giving you a dividend, look at the CFI statement. It doesn't matter. It's just cash going out. And so that's the point. It's cash going out. And here's the thing. Free cash flow. When we define free cash flow, to see if anybody was paying attention, I said free cash flow was, and this is also in the book, was gross cash flow minus gross investment. It's what's left after reinvestment. What do we also say about free cash flow? So we said it was gross cash flow minus gross investment. It was cash left after reinvestment. And then we said that equals what? What does free cash flow equal to? The theoretical payout rate of the firm. So that's the point. If you generate free cash flow and if you don't pay it out, where does it go? It goes into excess cash. Not reinvested in gross investment, it goes to excess cash. So excess cash is just cash waiting to be paid out. So if I have the cash sitting there and I've already expected to be paying out, when you pay it out, it doesn't affect the value of the firm because I've already expected the excess cash to be paid out because it came from the free cash flow. So the real value is that free cash flow. And the payout is going to be that free cash flow over time. And so again, back to whether I pay it out as a stock buyback or a dividend, doesn't matter because I've already expected it to be paid out. And then it's just what's the most tax efficient way of paying it out. But it doesn't affect the intrinsic value of the firm. It doesn't affect the enterprise value. It doesn't affect the free cash flow. And again, I say this because so many people in the real world, on the news tonight, will be using that logic. CEOs will say this. And I just snicker because it's not right. You don't buy your stock back because you think it's undervalued. It's undervalued because of other reasons. But more importantly, here's another thing. If you really think it through and you're buying your stock back using the rules that we now understand in this class, what's the real problem? Why would you buy back your stock? What's the decision rule for buying back the stock? When should you buy back stock? What did we say earlier? Yeah.
If you don't have positive NPV projects.
Exactly. So think about that. My message to you is I don't have positive NPV projects. My company's worth more. That's what you're saying. That's why I said it doesn't make any sense. If you think it through, it doesn't make any sense. Because if you had positive NPV projects, the answer should be, I'm investing more in my business because I got these great projects. Stock should be worth more. That's the right comment, right? But that's not what people say. Because otherwise, you should be investing more if you really thought you had all the great projects. And if it's not that, and it's just you just don't understand my free cash flow, then again, it has nothing to do with the stock buyback. It's just your expectations of those cash flows are different than my expectations of the cash flows. So let's play cash flow readjustment game. But that, again, has nothing to do with stock buyback. And that's what I'm telling you. This is what you should be getting out of this class, is seeing how the cash flows work and a true understanding of what's happening with the values of the firm. And this is much more nuanced than what you're taught in most basic financial classes. And the data over time proves this works. So this is what you'll see actually happen to real stock prices over time. That's why companies will buy back their stock price, buy back the shares. Share price goes up because there's fewer shares. They're playing an accounting game. It's accounting manipulation. It's not value manipulation. Okay, so it reduces your shares, so you increase your earnings per share, and it makes it look good because then your share price goes up because you will have fewer shares, but the actual value of the company is not changing. Okay, so it helps your bonus because my bonus as manager is driving EPS. So it helps my bonus, means I get paid out, doesn't mean the company's more valuable. All right, but we all play that game. All right, that's, by the way, that's going to be essay question number 4. Because it's so fundamental, and if you don't understand this, then you haven't really picked up on what's going on in this class. So I've already given you more than half of what the exam is today. All right, we're running out of time. So here's the final exercise, our final 10 or 15 minutes. Yeah. Can I do what?
Basically, the last 3 things you chose.
The last 3 things I what?
Last 3 things you said.
This is being recorded. You're welcome to listen to the video. But the short answer is you're going to have a question on CFI. You're going to have a question on the ROIC tree. You're going to have a question on whatever Mike talks about on Wednesday as a guest lecturer. And you're going to have a question on stock buyback versus dividends and rationale for why you do all this stuff. That's part B of the midterm. Those are the open-ended essay questions.
Is there
What you need to learn? I mean, what you need to learn for which question? So if you're talking about the last question, in terms of what drives stock buybacks and dividends, it's what we've been talking about for the last 10 minutes. So it's understanding the rationale of what all the formulas and what all the readings of the book have been telling you. Because everything I've told you is actually in the book. Right? So it's not like this is brand new material if you've actually paid attention and read the chapters. So this is what I mean by you can't just be plug and chuggers. If you're plug and chuggers and you think that a finance class is simply about solving equations, you're not going to do well in this class because that's what this class is not about. This assumes you don't screw up the math, but once you do the math, you got to figure out what the math tells you. Yeah.
You mentioned earlier the cash, excess cash, we expect it to be paid out.
Exactly, because where does excess cash come from? Excess cash comes from free cash flow that hasn't yet been paid out. Because if you paid it out, then you wouldn't increase your excess cash. It would just go straight to the CFI, and then it would go straight to whatever investor you then distribute it to.
So we couldn't use it for future investments, or we just don't
Well, here's the point. If you use it for future investments, is it non-operating? Think about that. If you use excess cash for future investments, is it non-operating? No. It would then be classified as operating. It would then be gross investment, and then it would reduce your free cash flow in the future. So the point is, excess cash, by definition, is non-operating, and therefore should be free and clear, that's why it's called free cash flow, from being necessary to run my business. If it is necessary to run my business, then it's operating, and it's not excess cash, and it's something I can't pay out. Right? And it gets real tricky, because I work with banks. And one of the things banks have to do is they have to meet regulatory capital requirements, where you have to put aside a certain percentage of your assets for safety. Okay? So the question is, it's cash, but they can't lend it. Okay? So is that truly excess cash for a bank? If the government says you have to keep cash in an account that is non-lendable as security against future defaults, is that operating or non-operating? It's operating. That's operating cash. Even though it's cash, and it's excess cash, it's not really excess, but you can't pay it out. It's actually tied up in the business. So if it's tied up in the business because it's actually running your business, that's operating cash. So the whole point of excess cash is it's free cash flow. Free cash flow means you don't need it from the operations. It's the net of what the operations generated after reinvestment. So that's the cash that you should be able to pay out. And that's just a question of when. Now, if I want to hold it as a rainy day fund and then wait to pay it out to later, or if I have for tax reasons don't want to pay it because it's international and I'm worried about figuring out how to get it back to the U.S. to pay it more tax efficiently, then I'm still waiting on the cash to be paid, and I eventually am treating it as a payout. That's why when you see a company buy back its stock, it doesn't really affect the value of the company, right? But what matters is the impact on people's expectations, because that's the key. You're really playing the expectation game, right? And you're just playing the expectation game by a different form of bribery. Here's some cash along with my change expectation. Please believe me when the stock price goes up. I'm not saying that's not effective, because people like having cash, and when they're counting their billions of dollars, it's easier to hear the message you give me. Yeah.
So essentially you're saying there's no point to the company holding excess cash except for strategic manipulation
Or other strategic reasons, meaning I want it for strategic reasons, right? But theoretically, if I start using it, then I have to reclassify that as operating. I can't call it excess if I'm actually going to tie it back up in the business. But if a company has cash, the assumption is you can choose to pay it out. Now, even if I hold it for strategic reasons up until the point I decide to put it back in the company, it's still cash that can be distributed. So I'll treat it still as excess. That could be a dividend, could be a stock buyback, could be a debt payoff, could be a payoff of the retirement related liabilities. So I won't hurt you, but in the future, if I'm holding cash that I'm going to spend in 2 years, then I have to change my valuation to assume that I'm spending it in 2 years on new equipment or whatever. And I can't truly treat it as a payout in the future. Okay? All right. This has been recorded, by the way. So all of this is on the video. All right? And by the way, it's been talked about in the book. All right. Last but not least, we're running out of time. I also put up in the file section a folder called the Supertree. It's got 3 files. So this is one of the things you're going to do after the midterm, and they're PDFs. So let me open up the Supertree. This is the Supertree for the defense and aerospace industry for 2011 to 2015. So here's the idea. Instead of just doing the ROIC tree for one company, we do the ROIC tree for the industry. All right, so we'll pick 5 other peers at minimum. So we'll have 6 companies in the industry minimum, and then the ROICs are not just the company, but we look at the trends at the industry level, which is the average of all the companies. So that's what the average represents, right? So that's also very important because I want to see how the industry is doing, industry analysis, and more importantly, I want to see how my company is doing against the industry to understand competitive advantage, all right, and understand relative peer performance. So when you have the exam next week, I haven't decided, but the fact that we're doing this exercise shows the way I'm thinking about doing this, that your ROIC tree analysis will be a Supertree analysis, right? Which means you're not just going to get one company to analyze, you're going to get an entire industry to analyze as part of your midterm exam. Yes?
How many companies do you use for the industry? Just top 6?
At least 6. At least 6 for our purposes. Now, I'll put an asterisk on it because, for example, if you were to do like Walgreens and CVS, it's Walgreens, CVS, Rite Aid, and there aren't any more big drugstores nationally. So some industries are just, or Home Depot, Lowe's. There's not a lot of home improvement stores. You won't get 6. But generally, if there's a lot of peers, you want to get a representation of the biggest peers that are most of the industry size. Okay. So technically, if you got a bunch of small peers, you probably want to put a bunch of more companies on that list. But for purposes of our analysis, we're generally going to do at least 6. So on your group projects, post-midterm, you're going to create a super tree for the company that you select to work on, and then all of its competitors. So you're eventually going to do this as part of your group projects. So back to the tree. This is the defense and aerospace industry. RTN is Raytheon. LMT is Lockheed Martin. NOC is Northrop Grumman. L3, COL is Rockwell Collins. BA is Boeing. Average is just a straight average because this is not Bloomberg calculated market cap weighted average. This is just a straight average because it's harder to do the market cap weighted average without Bloomberg. So long story short, unlike what you just looked at, this is the average is what we'll call the industry. So what we'll do is we'll see what's happening with the industry and then what's happening with our company against the industry. So let's say that the company we were analyzing was Northrop Grumman, NOC. So in the interest of time, I'll just do this very quickly myself. But the idea is ROIC for the defense and aerospace industry between 2011 and 2015 went up or down? Down. So it got a little worse, right? As we look year by year, it was actually improving from 11 to 14, and most of the drop to 17 happened between 14 and 15. So there was an event at 2014 that hurt the industry ROIC in 2015. Anybody know what it is? I wouldn't expect you in the midterm to necessarily know the answer. If this were your group project, you should absolutely know the answer. But in this class, does anybody happen to know what hurt the defense and aerospace industry at the end of 2014? Yeah.
Was it the shutdown?
It wasn't the shutdown, but related to the shutdown, it was called the sequestration, the sequester. This was the impact of the sequester when the government arbitrarily cut the budget for all spending on defense by a certain percentage and went across the board. Right? And the reason why you can see it affected the industry, and this is why it's also important to do the analysis, is because if the ROIC drops for one company, does it drop for all the companies? And what we clearly see is for 5 of the 6 companies in the industry, the ROIC went down. So this wasn't just one company who was having some problems in 2015. It was 5 of the 6 companies went down, which says that there's something going on at an industry level, not just a company level. And that's the other reason why we're going to do the super tree, is because the super tree starts telling me, are a lot of peers moving the same direction? Or am I the, when Delta, for example, had the big jump in operating margin, do we see the same thing at Southwest? Do we see the same thing at United Continental? Do we see the same thing at American? All right? Because then it's an industry trend as opposed to one company trend. That's going to be important for us to understand. But nonetheless, the industry trend was relatively consistent ROICs, but more importantly, slight drop between 14 and 15, and a little bit worse between 11 and 15. Tax rate. Industry, again, tax rate around 28%, falling to 24%. That should have helped the industry ROIC. So clearly, it was the pre-tax ROIC that hurt the industry. Second thing we notice is Northrop Grumman. Northrop Grumman's after-tax ROIC and pre-tax ROIC, because they're paying a higher tax rate than the industry, are both lagging. Okay, so Northrop Grumman is underperforming the industry in ROIC. Northrop Grumman is paying more in taxes, which means Northrop Grumman not only has a worse pre-tax ROIC than its peers, but it's been consistently worse all 5 years. So Northrop Grumman is not doing as well as the industry average when it comes to pre-tax performance of the actual making of whatever it makes. Right? Next level down, margins. Margins in this industry went from 11.5, peaked at 12.6, and then fell back to 11.6. So virtually unchanged over 5 years, but it kind of bubbled up and then went down. And it was the 12.6 to 11.6, that 1 point was the impact of sequestration. Yes?
Like the other tree, do you want us to include the 5-year percentage change?
On the Supertree, probably less so the 5-year percentage change, but impact is still important since we're talking about the trends, right? Because this you get something that looks like this on the midterm. Yeah,
So we're getting both the Supertree and the
it'll be an or. It'll probably be an or in the midterm. I just haven't decided whether I want to go with the Supertree or the other one, but the fact that I'm talking about the Supertree shows you which way I'm leaning. Right. So back to this. Operating margin improved with the drop-off. Here's the thing. Northrop Grumman consistently higher operating margins all 5 years. That tells me something. Right? And what's interesting is productivity. Productivity for the industry got worse, spending more money. Northrop Grumman spends even more money every single year than the industry average. So here's the other thing I noticed. Northrop Grumman has worse productivity than their peers consistently. Higher margins, worse productivity, but that worse productivity hurts their ROIC. When you get to the second level of the tree, what you will see same idea, right? What helped the industry was gross margin and SG&A improvements historically. And then what you can see is this industry, I won't go into time, you can see it here, but this industry was really hurt by intangibles to sales. They spent a lot of money in acquisition premiums in the defense and aerospace industry. Right? And that's what's really been hurting their productivity more than anything else. Right? And then the final Supertree analysis, might be worth it to take a quick look at, is there'll be a Supertree for CFI. Right? But in the Supertree for CFI, I've simplified it to 4 major numbers. So unlike the CFI, which has a whole bunch of stuff, these are what I would call the top 4. Number 1, what's happening with gross cash flow? Over the 5 years, the defense and aerospace made almost $91 billion worth of gross cash flow. Number 2, free cash flow. After reinvestment, they generated about $55 billion worth of free cash flow. Number 3, the payout rate as an industry averaged 25% over time. Key point for me to understand, which means if the reinvestment rate was 25%, what was the payout rate? 75. And in this case, the industry actually paid out 61.7. So they had 75% available to pay out, but they actually paid out more than 75% because they had $55 billion of free cash flow and they paid out $62 billion worth of cash. So what can I infer the difference might have been caused by? How'd they fund the extra $7 billion? Probably debt. So just as McDonald's probably took advantage of low interest rates, the defense and aerospace competitors probably did as well. Okay, so again, we can see some company trends, we can see some industry trends. The analysis is identical. The only difference is if I have you compare yourself, a particular company, against the industry, and what you'll see is Northrop Grumman has been doing relatively worse than its peers, higher margins, worse productivity, and when you look at cash flow, reinvestment rate at Northrop Grumman, you can see it here, has been fluctuating much more than the rest of the industry. And more importantly, they have been consistently, they bought back $12.5 billion worth of stock, right, and paid out dividends. So here's the thing. Would their stock price have done better over time than the peers? If the idea is that buying back the stock would help their stock price, then I would say it'd be interesting to compare their stock price against their peers. I'll give you a hint. They underperformed, because their ROIC was lower and their future expectations are a little worse. So nonetheless, those would be some additional insights we would get to later, but this is what you're going to have to do on the midterm. Final questions? All right, yes.
So for the midterm, we're gonna have a super tree.
I haven't said for sure, but it's likely you will have a super tree as opposed to just a simple tree. But I don't know yet. I haven't actually created the example. Yes.
What is it, negative reinvestment?
Negative reinvestment means you're selling off assets. All right. So last but not least, I recorded this. It will be on YouTube available. So again, Wednesday guest lecture, next week midterm. We'll pick up with the valuation model and the forecasting on the 17th after the midterm. Good luck.
Yep. Have a good day.
Yep.
I have a question.